Welcome, everyone. It's Angelo Robles, founder at Family Office Association and host of the Angelo Robles podcast, and Family Office on YouTube, but Angelo Robles podcast on Spotify and Apple. We have a special guest today. He was one of our most popular guests that we had on last year, and that simply is a math game, who gets the most views. So David, great to have you back. So our special guest today, he made it to the title, so you know he must be really important. It's Understanding Markets with 40-year Wall Street veteran David Hunter. That, of course, means it features David Hunter, contrarian macro strategist with 40 years on Wall Street. David, welcome back to the show.
Yeah, thanks, Angelo. Glad to be here.
A pleasure, a pleasure. And to even our recorded audience, I normally have my show notes. Something's not working properly on the printer, so I'm going to rely a little bit of looking at my screen or my iPhone screen. So pardon if my eyes look more diverted than normal, but I promise I am paying a lot of attention. David, we have a lot to talk about because there's lots of things going on this year, and we still have a lot of the year left. So some of it's going to be crystal ball and futuristic thinking. Why don't I start a little more broadly? What's the best investment advice that you ever heard?
That's a good question. I'd say probably early in my career. I'm not sure where I heard it, but I certainly learned pretty quickly that markets are as much psychology as they are fundamentals. So don't ignore the psychology, I guess, would be the advice that I heard.
I think that's great advice, because if it was strictly only by the numbers, like we'd all have it figured out. It's a little more complicated than that. And markets are probably more inefficient than we would like to admit. Why don't we jump into a subject that you have very strong opinions on? Your great Twitter follow, by the way. We'll get to that later, but I recommend everyone follow that. Are interest rates, really meaning 10-year treasuries, heading back to 1% or above 3%? I believe as of today, they're 2.038.
Yeah, that's a great question, because obviously most everybody today thinks they're heading higher. And I've come out in the last week or so saying, maybe it's a little longer than that even, but saying that we are probably going to see a 150 on the 10-year before we see a 250. And so I, months ago, forecasted, many months ago probably, forecasted a 2.5% 10-year in this tightening cycle. I don't think it's going to get a lot above that on the 10-year. And I thought we were probably going to go more in line to there, but it looks to me now, with so many people on one side of the boat, that there's a good chance we're going to have a rally in bonds here very shortly that takes us back to 1.5 before we go to that 2.5. So I'm still expecting higher rates ultimately, but I think everybody's expecting them to go in the straight line here, and I just don't think that's the case.
Yeah, it seems like it never is. If the Fed doesn't go up, whatever, 50 basis points in March, or goes up only once and done, could we be off to the races?
Well, yeah, for sure. I have a melt-up call and an equity melt-up call coming. So, yeah, I think we're kind of in the finishing touches of a correction that started back in November. I think once we get through this correction, yeah, we can be off to the races. I said in my January letter, there's not so much what the Fed does. I have no idea what they're going to do in March, whether they hike 25 basis points or 50 or not at all, as much as that seems unlikely right now. I think the bigger story is the narrative, what I call the street narrative, meaning what the street is expecting. And as you know, in the last few weeks, we've kind of been playing leapfrog in terms of who has the most hikes for 2022. Is it 4? Is it 5? Is it 6? Is it 7? And that was the bidding up of expectations. Everybody kind of jumped on that side and said, oh, the Fed's way behind the curve. They've got a hike. And I think what's being ignored right now is the speed with which the economy is decelerating. And you can look at steel, you can look at several different indicators that are telling you the economy has already responded to the tightening that the bond market's been in the process of doing for several months here. So I think the surprise is that in the next month, between now and the March meeting, the Fed may begin to pay a little more attention to the economy and a little less attention to inflation. And what I call it is, you're going to see a reversal in the tightening narrative. So that doesn't mean the Fed doesn't raise rates in March. I have no idea, but it does mean that the street expectation is going to be moving away from extreme tightening concerns to, hey, maybe the Fed can't tighten too much, that the market's already done its job. We are almost at an inverted yield curve already. So rates on the short end have moved up faster than on the long end. And that's tightening.
I mean, would you say, staying on that theme, would you say that we're already priced in potentially for even a 50 bips bump up in March? Is that priced into the current markets?
I think it is. I mean, I think,
so
and certainly hikes beyond that. Bullard was out the other day talking about 100 basis point hike, and we've had, as I said, we've had the not in one meeting, but over the course of the next few, and we've had certainly, Bank of America had 7 hikes for this year as their forecast. So I think all of that is already built into the market, or a lot of it is, and yet you've got everybody looking down in the stock market, expecting much lower, because they think there's a long tightening runway ahead. If I'm right about the Fed having to pay more attention to the economy again and back off, and maybe even understand that their jawboning got the market to do their job for them, that from there you can have a pretty good run in the equity markets.
I hope so. Let's talk a little bit negative of potentially what could happen come March. Suppose they do raise more than 50 basis points. Could we have a crash and then they'll reverse?
Anything's possible. That's not even a high probability or a reasonable probability in my forecast. I think, and I'm not trying to forecast what the Fed will do, because the Fed is a group of people that can decide whatever they want to decide. I just don't think the economy is going to allow a lot of aggressive tightening, and so they can make a mistake and do something here. But I think Powell's shown himself to be aware of what's going on around him.
Right.
Unlike Bullard, I think he is measured in how he looks at things. And I think they will prepare us. There's not going to be a surprise in March. That I can promise you. They will let the markets know ahead of time. They don't like to surprise the markets and have the markets, have any big sell-off. So I think we will know ahead of time what they're kind of leaning towards. As I said, we've got a month to go, and I think there's going to be week by week data coming in here that may shift their thinking from where they're at right now. So, my convictions are pretty high that we are on the verge of a final melt up leg to this bull market that I say started back in August of 1982. So it's a 39-year secular bull market. And I think we're on the verge of a parabolic run. And people will push back on Twitter on me and say, we've already had that melt up. And then I say, yeah, you're right. We've had a melt up since March of 2020. This is the final, more vertical part of that melt up. So what I call the final melt up leg. And I think it's going to be very, very steep and very, very large.
I hope so, but then there's going to be a converse to that, which we'll get to coming up. So it does seem like, and you've been different, and I hope you're right, but like everyone knows the Fed is going to raise rates, 4 to 7 times this year, which means they're not. That would just be disastrous, I would think, for the economy. There's midterm elections coming up. I just don't see that happening. Like you said, anything is possible, but to me, that doesn't seem like a likely scenario.
Yeah, what I think we're seeing more here is people, again, I talk about psychology, it's people's emotions kind of running wild with the idea that, gee, inflation, especially saw the PPI today, inflation's running wild, and they just start extrapolating out with, one rate hike after another, and they really are only paying attention to one side of the equation. And I think the economy is the other side of the equation that has to be paid attention to. And don't forget, we had 2018 when Powell did have the attitude, hey, this is on remote control. We're going to raise rates no matter what. He
Right.
had his head handed to him on Christmas Eve 2018. And I think he learned a very big lesson at that time, that he's got to look at both sides of the equation.
It's probably me looking a little too deeply into it, but do you think the Fed needs an excuse not to raise rates? And I wonder if they'll use the geopolitical risk that we're seeing around the world as kind of that excuse.
Yeah, I'm not in that camp. I do really believe that Powell is trying to look at the data, look at the risk side, as well as understand that if the economy is his primary, it's the obviously the jobs and the economy is one side and inflation's the other side of his mandate. I think he truly is trying to balance those two. He's it's not an easy job right now, because I do think the economy is decelerating and inflation is accelerating. So I don't think I don't think they're playing games. I think they are really trying to be judicious, but they also are knowing, at least have learned enough not to prejudge what the next month's going to be. I think that's why, when Bullard came out the other day and started putting out what he thought they should do, there was a lot of pushback. Several other members of the committee came out right after that and said, I'm not there yet, and so I have, I don't know, but I wouldn't be surprised if Powell basically said to a few others, we need to counterbalance that. Jim's stating what he believes, but he's making it sound like that's where the Fed is. So
For sure.
so I think Powell is really trying to be judicious about this, and I don't think he necessarily is using or is looking to use Ukraine to kind of keep him from hiking, because he knows if he ignores inflation and inflation is roaring away, it's only going to make his job harder down the road. So I truly don't think it's they're set in one direction or the other.
It's probably jumping the gun a little bit, but you did kind of cue it up, where we may have this massive end of a really long bull market cycle. And yeah, make money while you can. Now, we may have different perspectives about what it may look like after that, but from your perspective, how long will that run? And do you think we're in for a very, very rocky 5 or 10 years after that?
Okay, first of all, in terms of, my forecast is that we're going to see 6,000 on the S&P in this melt up, and probably 20,000 on the NASDAQ, 45,000 is my target on the Dow, 3,000 on the Russell. So that's, 30 from here, probably 30 plus 35%, and 40% in some of the indexes. That's a huge rally. And I actually think we could be there by the end of the second quarter. So sometime in the second quarter. That's a unbelievable and unbelievably steep rally. Pretty much unprecedented. When I say melt up, I mean melt up. And as I say, there's a lot of people throwing the term melt up around, and I take credit for that because I've been talking melt up for a long time. But
For sure.
now people use that term every time there's some kind of a rally that's, outsized for a day or two. And, back the end of the year when we had the rally, I was told I'm missing my melt up. And I said, this isn't the melt up yet. So, but people will find out what melt up really means. And I think it's going to be a parabolic, steep rally that will be relatively fast. It could happen in 3 or 4 months. Doesn't mean it has to. There's no wall at the end of June that says, okay, we're not there yet, we have to stop. It could carry further, but I just think it's going to be very steep, and we'll get there pretty quickly. As for the other side of the mountain, as you know, I'm calling for a global bust and an 80% bear market. So bust refers to the economy. And, the bear market is 80% is bigger than anything we've seen in the post-World War II era. So those are big numbers, and obviously speaks to something pretty awful. But actually, the reason I use bust is because I don't think it's going to be long and drawn out like a depression, like the 1930s. This will be something that I think is more attuned to 2008-9 in terms of its speed. So it's contained most of the damage, I think, is contained within a year. Let's say it starts, later this year. It might be over by, mid to late 2023, and we're into a new cycle after that. So it's going to be, as I say, my definition of a bust is something that has a lot of the characteristics of a depression, but happens at the speed of a recession. And so I don't see it as 5 to 10 years of down after we roll over. But I will say the damage will be there, so there'll be lingering effects that'll carry on for many years afterwards. But we'll be in a recovery mode because I expect the central banks of the world, because this will be global, will print more money than by a factor of many.
Yeah.
What we just saw, this last 2 years, we saw 5 trillion come out of the Fed. I'm expecting it to be 10, 15, maybe even 20 trillion. That's what it will take to stop the free fall of the global financial system. So you could have a Federal Reserve balance sheet that's certainly 20 trillion and could even be 30 trillion by the end of the bust. And those are just numbers that are beyond imagination. I mean, I don't know how you wrap your head around anything like that, but it's the only tool they will have when you've got a global collapse on your hands. When you're looking at big banks around the world failing, and I mean failing, probably more elsewhere than the US this time around, there's only one thing they can do quickly, and that's print money. So you'll see the ECB, you'll see, the Bank of Canada, Bank of Australia, you'll see, the Fed, obviously, People's Bank of China. Everybody's going to be printing money like there's no tomorrow. And that will, with a lag, bring on a recovery cycle.
Okay, we may get a little sensitive here in certain topics, but that does bring up, if it's going to be that bad, even for relatively a short window, whatever, 6 months, a year, 18 months, that could, coupled with other issues occurring in geopolitical, that may cause some level, could I go with the word chaos? We all know what's kind of happened to San Francisco. Could we see things get really bad?
Yeah, I think there'll be chaos. I think this one, because it will be, and I understand that if it's 12 to 18 months, that'll feel like an eternity.
Right.
But because it's relatively quick, I really don't think it's going to be all that, in this country anyway, all that much chaos. There'll be, we have chaos in the last 2 years, so there'll be more of that. There'll be, in the inner cities, there'll be more of that. But the government, as I say, the one thing that differentiates me from a lot of the gloom and doomers out there, the Peter Schiffs of the world, is I say,
It's a friend.
as I say, we have a printing press, and we're going to have relatively low inflation because of the bust. They will have almost infinite ability to respond with money and with government expansion. So that is why this doesn't turn into the ultimate collapse. By the 2030s, my forecast is we will see the entire global system collapse. It'll be the unwind of, the Ponzi scheme that's been in place for the last 50 years. But that's not this time, because we have a printing press, and we'll have relatively low inflation, even though it doesn't look like it right now. So they will print till there's no tomorrow. They will be able to provide whatever they have to keep the chaos from getting out of hand. There'll be support systems. When we get to I don't mean to jump ahead, but when we get to the 2030s, the government will be bankrupt. There'll be no support system, no welfare system, no Social Security, no Medicare, no Medicaid. And basically it'll be a global collapse of the system. So that'll be true around the world. Then who knows what fills that void? But that's, that's not this decade, that's next decade.
Yeah, I'm glad you brought that up. We'll probably have you back at a future time to discuss that, but it does leave open something that I got to cover for a minute. Uh, I completely agree with David on that. And I've been talking about, and I have a masterclass series for my significant families called Sovereign Risk, which really includes everything that could go wrong, that I think will go wrong. And the challenges, especially many American families of great wealth, like billionaires, are way too concentrated, don't have optionality. Now, I agree with David, that's going to be global, so it's going to be hard to escape. But there are some strategies to help mitigate what may be massive chaos. I don't want to start to scare everyone. I'm already a little bit of a doomsdayer. But why don't we save that one for a discussion that I'm going to have with various guests this year, and we'll have David back to talk about what could be maybe strategies looking forward, whether they're real assets, etc. That being said, I know it's not, unless you changed in the last year, it's not your main thing, but I'm going to ask you anyway. What you just described with basically print, print, and print is the argument that the people in Bitcoin, rightfully so, will make on centralized versus decentralized and the limit of 21 million. Have you warmed up just a little bit to the potential of Bitcoin or something like it, or just not yet?
Well, let me answer it this way. I'm far from anybody should ask their opinion, ask an opinion on Bitcoin, because I don't follow it, and I certainly plead ignorance. But what I will say is that a lot of the attraction of Bitcoin and crypto is that whole argument that we need to get out away from central banking because they've destroyed things. They've done such a poor job, and that this is the answer to that. And I completely disagree with that. I'm not arguing whether Bitcoin will be a survivor in this and be, a thriving entity, once you get through the bust. I have no idea. I'm not an expert on that. But what I am pretty confident in saying is between now and the 2030s, the crypto space is not a solution for anything that we're going to be facing. And I as I say, a lot of this is the Austrian school and their whole, they hate the central banks, obviously, and they think the central banks are the Darth Vader of monetary things. So they have bought into crypto because and into Bitcoin because it is outside the system. My problem is, given what I'm describing, which is the global bust, right in front of us, if we were to follow the Austrian prescription and basically do away with money printing, we, instead of the 2030s, we'd be down for the count next year, right. and we'd all be living in caves. There'd be, it'd be a total collapse of the system if we do away with that. So I'm not endorsing what's going to happen. I'm saying it's inevitable that we're going to see massive money, not only here, but around the world. And that will jumpstart an inflation cycle bigger than what we saw in the late 70s, early 1980s. We will retrace in the 40 years of disinflation, where we dropped the long bond down from 15% to 1%, and the right. 10-year down from 15% to almost, to 40 basis points. We will retrace that all the way so that you'll be back to 15% long bond. You'll be back to 20% plus T-bills. You'll be back to inflation above 20%. That's what I expect. And that's why I call for a collapse in 2030s. We can't fund our debt if interest rates get anywhere near double digits, but they're going to get there. There's nothing the central banks can do to stop that. They're going to track inflation. And so, but, in terms of Bitcoin being a solution for that, what Bitcoin will be, coming out of the collapse, et cetera, I have no idea. But we're not going to, in the next 5 years, certainly, we're not going to lose reserve status of the dollar. And
that's for sure.
Yeah, and I don't know that we'll see it at all. The dollar's going to go down. I have the dollar going up in the bust. It'll be a flight safety trade. Could take the dollar back to 120 from what I think will be 80, because I'm calling for 80 in this year in the melt up. So the dollar's at 96, 97, can fall to 80 and then rally to 120 plus in the bust as people all around the world run to the dollar. And then from there, I think the balance of the decade, the dollar will ultimately get below 50. So
Yeah.
I'm not a bull on the long-term bull on the dollar. I do think it's got problems, but it's not going to, there's nothing to replace it as a
It's the
reserve
best of a
currency.
bad batch.
Yep. Yeah. Euro's going to have some real problems in the bond.
Yes.
I can't imagine how they're going to stay together when Spain and Italy are being hit as hard as the world's going to be hit. So, it's going to be very hard for the euro to even, hold together.
Yeah, I mean, people say that I tend to be a little bit of a cage rattler on things that are happening or could happen here in the US. Well, we're seeing it happen with San Francisco, with confiscation of assets, resources, of taxation. But by the way, it is worse in probably 95% of the world. So that does become the challenge of like, where do you go? Where do you hide? And, we'll save that discussion for a different time. What I will say, hinting at something that David said, you watch in the big cities, if there's ever the electrical grid going down and they're antiquated and a lack of water and supply chains, you give that 2 or 3 days and the feeling of banks are closed, no internet, you have instant chaos. You watch what the soccer moms will do. You'll see. Get prepared. You hinted at it already, but I think we have to cover it to some extent. What's your view on inflation? So we're hearing what, 5 or 6% for the government. We know that's nonsense. We know for rich people that are buying assets going up in value, buying homes in Miami, that their true inflation may be 20 or 30%.
Yeah, I'm in a funny place because I'm arguing that we're going to have, that the Fed's not going to necessarily hike rates. There's not going to be a big rate hiking cycle. That I think the bond market's already done the damage. So, and I do think a lot of the inflation that we saw in the PPI today, more so than the CPI certainly, is supply side oriented or supply chain oriented. In that, what we look what we did. We over the last decade went to just-in-time inventories, and everybody got, because of the long time disinflationary trends and the fact that the economy operated well below potential, companies got really, really efficient about, we want to just produce enough, and we can always get our inventories. If we're running low, we'll order that. We're not going to build inventories and get stuck with inventory. So you've had this just-in-time inventory trend that's gone on for a long time, couple decades, and then all of a sudden, pandemic hits, and you shut down the economy, so there's not a lot of demand, and then you pump money beyond anything we've ever seen in the world before, and you open up again, and you spike demand. The companies got caught with no inventory to meet the demand, so prices go up. And again, the place where that's true more than ever, or more than anywhere, is in the commodities. So commodities are not able to meet this exorbitant demand that came from, a spike in monetary and fiscal policy. And it's not just here, it's around the world. And as a result, you've got this short-term situation where there's not enough copper to supply needs. There's not enough, gas and oil to supply needs, et cetera. So what gives? The price gives. That's temporary. And particularly if I'm right about a bust following, this period, you're going to see the opposite happen. You're going to see prices go through the floor. You're going to see demand's going to stop on a dime, and all of a sudden, you're going to find out that some of that was a bit artificial or certainly short term. And so I think you're going to have actually temporarily a deflationary bust. You're going to go from inflation worries this year to by early next year, actually deflation worries. And then because of all the money printed to respond to that, you'll jumpstart a true inflation cycle, a longer lived inflation cycle that from 2024 through 2030 will do what I said, which is take inflation up to 20% plus. And, I have forecasts of oil at $400 a barrel, silver at $400, gold at 10,000, maybe 20,000, copper, who knows what, tenfold increase, natural gas, obviously through the roof. So you're talking about, and ag commodities will follow the same trends. So you're talking about an inflation cycle like we haven't seen since the early 80s. and probably bigger than that one by quite a bit. That's what's coming, but it's not straight from here. I hear everybody talking about a commodity super cycle.
Yeah.
As I like to say, it's the equivalent of standing on the south rim of the Grand Canyon, looking across the north rim and thinking it's a short walk across, when in fact you got this canyon in between. Well, if you're in commodities today, and I think they have a run here in the melt up, but if you're in commodities today and you think you can just hold them through the bust, I think you're going to be surprised at the canyon that's between you and the true super cycle.
Okay, let's dive a little bit then into, it's probably among the most common questions I get are investors and family offices, a so-called inflation hedge. And I always chuckle a little bit at that because somehow gold seems to have won that moniker. And yeah, probably through one cycle, I don't know, like 1974, it might have been true. I don't know if anything, maybe the dollar, anything is truly a great inflation hedge because that changes all the time. So why don't I start with this question? Are businesses with pricing power a good hedge for inflation?
Well, for sure. I think in the next cycle, this is kind of a way to answer your question. In the next cycle, every cycle, there's new leadership, right? So this cycle's been the technology companies and the social media companies, the FANGs, et cetera. The next cycle, those are not going to be your leaders. Your leaders are going to be commodity companies and industrial companies. And the reason they'll be the leaders is because they are going to be the companies that have pricing power that can outpace inflation. The growth stocks are going to be facing ever higher interest rates and particularly the steady growers, an inability to offset the rising prices. And so, yes, I think for the next cycle, it also will work here in the next 4 or 5 months. I think commodities are a place to be. I mean, I think companies with pricing power like commodities are going to be at the top of the list.
I mean, I find it intriguing that Bill Gates, or through the foundation, appears to be buying a massive amount of farmland. I'm assuming you would look at that as being upcoming, probably a superior inflation. Although I just said, I don't know if I believe in them, but a superior inflation hedge.
Yeah, I get the question a lot about what about real estate and the environment I'm describing. And I go, people think of real estate as an inflation hedge, but housing, if you think about housing, people today basically price a house based on what they can afford on a monthly basis. And if your mortgage rate goes to double digits, you're going to have a problem with pricing because prices are basically an inverse to the interest rate. So I don't think housing in general is an inflation hedge. But what I have said is the one type of real estate that I think will be a great inflation hedge is farmland. And particularly given that I think the ag commodities are poised for big runs in the the post bust period. So I think farmland and maybe housing around the farm belt will do far better than the coastal areas and the areas that have done so well in the last 10 or 20 or 30 years.
Interesting. I always seem to have to talk about the legendary plunge protection team, or formally the president's working order on financial markets, going back to, I guess, President Bush in 1989, helps keep the stock market from wild swings. And I guess either way, perhaps, we always assume only helping to protect on the downside. That's pretty hardcore manipulation. As a hardcore macro guy, do you like that? Or I guess it is what it is. We have no control over the government, do we?
Well, I'm not in that camp, frankly. I having started in this business in 73, so actually 48 years doing this. And I saw the Nifty 50. I came in when the Nifty 50
I remember that
topping out. So, I've watched, and I'm a big economic cycle guy, market cycle guy, not time cycles, just market and economic cycles. But I've watched the Fed do what they do through all these cycles, and I don't think people are understanding what Fed policy is, and I think myth grows out of that. And so everybody, I'm not saying there wasn't a plunge protection team back in 2008-9. Certainly there was, but I do not think the Fed is in there buying stocks all the time or manipulating the markets. People do not understand, again, they don't understand psychology, and I don't think they understand how, how markets work. And so, it's out there, just like people say gold's being held down by manipulation because they saw the cases against spoofing,
Right.
and I go, spoofing is pennies. They're skimming pennies, but they do it in such volume that they make some money. Or, or there's trading desks that manipulate stocks so that they can buy them cheaper. I'm not doubting that there's manipulation out there, but I really don't think it's the Fed. That's not where they're focused. I think they're focused on the economy. They do know the stock market's tied to the economy, and so therefore they don't want to create crisis in markets. But I don't really think they're manipulating the markets in any big way.
I'm going to read this, and pardon me not giving attribution. I forgot where I got it from. 3 things cause consumer inflation. 1, raising wages, sticky, hard to take back. 2, price controls can be transitory. And 3, supply chain shortages, also transitory. Broadly, do you agree?
I certainly agree. All of those
Right.
can be, but I think there's one big one left out, and it's what will be the biggest part of the inflation cycle, and that is demand driven. So wages are cost driven. Wages come later. But I lived through, like I said, I started in 73. So I lived through the whole cycle in the 70s and early 80s. I find a lot of the economists that are younger, there's a big advantage of living through it rather than reading it in a book. And I don't
There's a
think
big difference. I know.
I don't think they really understand how much demand driven inflation starts the process, and then the cost driven inflation, basically wages, comes later. And then the government's response, like whip inflation now, the price controls, which is fallacy, but they can't help themselves, and they think they can manipulate, they think they can control things, and all it does is lead to even higher inflation. So yeah, I agree with all 3 of those, but I really think demand pull inflation is something that gets forgotten a lot.
Money printing alone does not cause inflation, and some people agree with that and some people don't.
Yeah, I'm a monetarist, so I do believe that you print money for long enough and you're going to get inflation with it. And I am a big Milton Friedman person. The problem I have, and you get, as you know, you get a lot of these guys out there and they say, well, velocity's down,
Right.
So you can't have inflation. So I go, velocity is a plug-in number. That's plugged in to make the equation work. Ultimately, you'll see the velocity when you get a sustained recovery after printing money the way I think we're going to see it printed in the bust period. So I really do think, debt has held us back. This massive debt buildup that we've had for the last 30 years, and particularly the last 15 or 20, has, I think, pulled us below potential in a big way. And there were issues with, you can print money, but if there's no demand for it, there is not going to be inflation in the short run. But we're seeing now, I really do think, as much as I think supply chain is part of this, I really do think it's the printing of money after March 2020 that is a big reason why we're getting the inflation breakout now. Not just money, but also the government stimulus, and you're getting demand being artificially lifted, and it's creating problems with supply demand issues.
Let's go to gold a little bit. Gold, like any other asset, goes up because there's more buyers than sellers inside the market infrastructure. Am I simplifying it too much, or is that actually pretty accurate?
Yeah, well, it's all, any commodity or any good is pretty much a supply demand picture.
Yes.
That's what drives it. gold from an investor standpoint, though, I mean, it's been if you go back all the way to 2001 when it bottomed, the double bottom, 99 and then 2001, back at 250 on gold. People seem to forget because they're so focused on today. Gold went from 250 to 1900 in a decade. And what we've had since then, from 2011 on, is a long consolidation. Part of it because you went from 250 to 1900, whatever that is, a sevenfold increase. So it's been up and down, but it's basically frustrated investors. I think we're on the verge of a huge breakout of that long consolidation.
Mhm.
So, yeah, it's supply and demand, but as you know, gold is very much a monetary element. I mean, it's not so much economic as it is, inflation hedge, monetary, what have you. So I do think with inflation getting hotter and the dollar, in my opinion, about to roll over, I do think the conditions are ripe here for a very big vertical breakout in gold, and a leg not dissimilar from won't all be this year, but a leg not dissimilar from the 2001-2011 period.
I'm trying to be a little funny and maybe it's a little off target, but why aren't baseball cards? Why aren't whatever video games, Pokemon? What defines a store of value, which you could argue is at the same as an inflation hedge? I may have a little different perspective on that. So my question's going to be, and I don't know if you studied baseball cards, David, I like them. This is a manipulated market effectively by even private equity and like firms. And do we just have to accept that a lot of things are not organic and natural, that many things, especially inefficient markets, they're often manipulated?
Yeah, manipulated or in the eyes of the beholder. I mean, we know art is very manipulated.
Yes.
And it's basically, it seems like a game to outsiders like me anyway. And I knew somebody that was involved with some of the big investors in art, and his wife was an artist, and he said, yeah, it's just, there's an aspect of it that's very gamed, and you bid it up and then you make the rest of your collection that much more, that much worth that much more. So I think what we're going to see, this may not answer your question so much, but I think what we're going to see is, if I'm right about this big inflation cycle from 2023-4 to 2030, you're going to see collectibles go through the roof. I think baseball cards, I think pretty much anything, antiques, everything that may not have been all that much in favor in recent years because of what we went through. I think you're going to see the return of what we saw in the early 80s, where you found people were bidding up things like crazy. If you have a collection, and you're later in your life, I would hold on and say that period 2027 to 2030 is going to be probably the peak of all assets. We talk about the all everything rally or the all everything markets of the last year. I think this is going to pale by comparison what we see then. And not because I think I'm famous for saying the peak in the stock market after this melt up, the peak this year is likely to stand for decades to come, maybe forever, in the stock market. But in hard assets, in real assets, in collectibles and things like that, inflation will take their values up, I think, late in the decade.
So looking ahead to that unique time and where things may get very interesting, what you're basically mentioning is baseball cards, gold, physical commodities. If it's not in an ETF or liquid format, broadly, these are not liquid, unlike whether, broadly the stock market, equities, cash. That's the trade-off is, in your world, it's going up in value, but your liquidity is going to be potentially limited.
Yeah, that's true. I mean, when we get to that true collapse, It's like, what are you going to do? Well, let's say you have to hightail it out of this country. I'm not saying there's any place to go.
Yeah,
You
that's the
can't,
problem.
you can't take it with you. Where, it gets
That I
confiscated.
was just going to get to that. And we'll go off in different tangents. And I know it's not something you put a lot of research in, so I don't want to put you on the spot. But that's where we may differ a little bit on the crypto and some of the digital side. Although what I will say about that, those markets are manipulated as well. And don't think that the governments don't have their hands very discreetly involved in some of that that's going on as well. If you think you could hide from Big Brother and the government, you have no shot. You can't. But might you be able to profit very well in some of those markets? Absolutely. But a subject for perhaps a different discussion.
Yeah, I will say to that, like I said, I don't view Bitcoin as a solution, a likely solution to the central banks. I don't think it's going to be allowed. I don't think it can do it. That doesn't mean it doesn't survive and thrive. What I have said is I want to see it get through the bust, because right now, I don't really like what I see. There's a lot of speculation surrounding crypto, and I don't really feel like it's a market that's been tested yet. So, I may feel, more positive towards it once it gets through the bust and proves itself, but it's so new. And I see a lot of those that are attracted to it simply because it's gone up. I mean,
Oh,
that's
for
the
sure.
problem.
FOMO. And that's the retail consumer and potentially now manipulation from the hedge funds and soon to be institutional players. I could make the argument Bitcoin has gone through 3 periods around the halving cycle where it went down 80, 90% and came back with a stronger floor and high than ever. And Bitcoin is one that we can make the argument has effectively no intrinsic value. And arguably, maybe that's its value as a store of value and arguably a monetary system. I'm probably a bigger advocate. This always makes the Bitcoin maximalists mad at me, but Ethereum, Solana, Terra Luna, other platforms that are actually doing things relative, even if they're NFTs, DeFi, and actually doing, let's go with the word, or if not quite there yet, but close, real world things. And I like Bitcoin, don't get me wrong. There'll be winners, there'll be losers. It'll be interesting how it plays out. Maybe I'll kind of leave it at that. You hinted at this earlier when you said the emotions of the market. There's a saying that I have, and I do scratch my head at value investors sometimes. I mean, maybe their cycle, a broken clock is right twice a day. A lot of this is a beauty contest. It's supply and demand in a given marketplace. And sometimes I think there's some investors, even way higher IQ and smarter than me, that they just don't realize that human psychology and other elements of game theory and things that go into the irrational or irrationality, I'll make up my own word, about how the markets really are.
Yeah, that's true. But what I would say is if you're a long-term investor, ultimately earnings matter the most, so you're not, your stocks are not going to be, they are not going to be able to sustain high levels unless they have fundamentals to back them, unless they're, but in short periods of time is where psychology really plays its role and really can take its toll. So
True.
we know investors go in herds. I mean, they chase momentum like crazy. I'm forever on Twitter saying, shut your screen down and ignore the tape. You're just getting caught up in the tape. And people go, what's the tape? I go, yeah, you weren't around when we had ticker tape, but it means, it means ignore the market. Don't get caught up in the momentum of the market. And in the short run, psychology is very powerful, and it gets people running into something, and then something happens and it goes the other way, and all of a sudden the same people that thought it could go up forever now hate it. So you just have to realize that how big a role psychology plays.
I mean, all the talk about the death of the dollar. And like you said, I agree, longer term, absolutely. There's definitely reasons to be concerned. But what is the alternative now? So this calling for the dollar doomsday, even if I look 5 or 10 years out, which I'm foolish to even try, and maybe it will be Bitcoin, who knows? But what's going to be, is it the Swiss franc? Is it some kind of combination of multiple different currencies? What is, if you had to take a guess and take out your crystal ball, what may replace the dollar looking out in the future?
The most likely is some sort of a basket where,
Right.
I'm not a fan of what's going on, but frankly, you don't have to look very far to realize that there's this new world order that's gaining more traction every day with, the pandemic feels like they were right behind it, and they're using it to, further their power. And so, these global entities, the IMF, the World Bank, et cetera, I would not be surprised if there's a real effort to try to do some basket of currencies to weaken the US and take away the dollar as it's what gives us so much power. But I don't think they're anywhere close to being able to do that and have it accepted at this point in time. Certainly China's nowhere near a point where their currency can be, looked at seriously as part of that basket. And the euro has its issues. There's really nothing. So to me, I can't see out much past 5 or 6 years, but I think in the next 5 or 6, there's no chance that the dollar loses reserve status. And I hear that talk all the time as if it's right around the corner. And I realize we can, 5 or 6 years isn't very far out, but I don't really think it's even 5 or 6. It's as I say, in the balance of this decade, I don't see the dollar losing status. It can certainly, there'll be some replacements. Russia and China are going to try to do whatever they can to work around the dollar. I'm not saying it won't lose some of its status, but it's not going to lose a major chunk of it. And where I think the changes can come are in the next decade, because if you truly get what I think you're going to get in terms of a collapse, all bets are off. I don't know what comes out of that. It's a huge vacuum. The likelihood is totalitarianism is what comes out of that, but I have no idea. And I tell people it's hard enough to predict the next year. Don't jump over the next. We're about to have what I think is going to be the biggest melt up / rally certainly in the post World War II era. We're going to have that followed by a global bust, the biggest downturn in the post World War II era, and then followed by the biggest inflation cycle in the post World War II era. Why jump over those 3 things and start worrying about something out beyond that?
Yeah, except for the melt up, the other ones are really, really bad. Yeah. And what you said about that 3-letter agency, I mean, I talk about this and I get in trouble. So I'm probably going to try to be a little bit nice here, or Twitter and YouTube hate me because they're very much, if you're not in one point of view, like basically zip up and be quiet. Yeah, a new world order looked at by varying entities around the world that have an agenda. And I don't know if there's much we could inevitably over time, it may take decades, there's much we could do about it. And maybe I'm being too negative. Maybe there's always something we could. And again, I guess I'm saving a lot of podcasts for the future that will all probably get banned and none of you will ever hear it anyway.
Well, I always say New World Order is code for communist takeover of the world. And we have a lot of naive people in this country who are all for it, and they don't realize what they're asking for. So, I'm afraid.
Well, I'm going to take a little different. Okay, let's get into that a little bit, but not too much. Yes, I am completely on board with you. I'm not so sure that they don't want it. They're afraid of the future. They want the government to support them in food and housing. Nothing else. You'll be on a scale of 1 to 10, you're going to be like a 4, but you'll be alive. The term that I've been using is they want you in that matrix where if you want to break out of it, that's getting harder and harder to do. If you want to make the money, make it now because you're going to need it. But I'm not so sure they're not going to come and take it from you in a variety of different ways. But you may not be able to escape what inevitably is going to be the new world order and matrix, especially as we progress in the metaverse and all that and control of our mind. These are all things I'm kind of a little bit of a fan of, an investor in. But I'm just fair to both sides and looking at the reality of how things may look. Have a really good time and try to enjoy the next 10 years because it may not be so pretty after that. Some of these movies that we joked at, The Matrix and The Terminator and things like that, they're going to end up having an element of truth to them. That may be a little scary. Let's take it. I'll try to wrap it up in 5 or 6 minutes. And I know you're not going to be the biggest fan of what's going on with the growth stocks and the FANG, although renamed now, I guess, with Facebook being Meta. But do you see a big shakeup in what we consider like the FANG plus Tesla and Microsoft? Is biotech companies going to make that top mark? Blockchain. It does seem like there's going to be changes happening and happening pretty rapidly.
Well, first I'm gonna talk about the very short term, which is the next few months. The melt up. I do think the melt up is going to be broad based, so I do think growth is going to play in that along with value. I think commodities will play, industrials will play, the FANGs will play, semiconductors will play, even Kathy Wood's ARC will play, and even biotech will play. Because as I said, I'm expecting the 10-year to go to 150 in this time frame. So you're going to have kind of the best of both worlds. You're going to have inflation playing at the same time, or inflation / industrial growth playing at the same time that rates are coming down temporarily. So I do think growth can play in there, and everybody's thrown them out. They've really been persona non grata in the market for the last several months. So I think they're at levels where they can be bought for a rally, and maybe a big one. Amazon and things like that could do very well. But beyond that, again, as I said, they're not going to be players in the next cycle because, and neither will index funds, by the way, because what drove this bull market from 1982 to now was a situation where interest rates went from high double digit to low single digit, almost zero, and PE multiples went from single digit up to 20 plus. You're going to have the reverse of that during the inflation cycle of the next, the balance of the decade after the bust, where PE multiples keep shrinking and shrinking because interest rates are going towards double digit and higher. And so, indexes will not be a place to be. It will not be like we've had for the last 25 years, where if you just bought an index, you outperform most active managers.
Yeah.
It's going to be the opposite, where you're going to have to find those managers who get the situation. They understand they have to own, things that beat inflation, and active managers will be back in play again. Growth stocks will face, particularly the big ones, the big names that are so widely held. Every time they lift their head after the 80% bear market, there's going to be another level of investor that says, "Oh, I finally got my money back. I'm getting out." So you got distribution that will go on through the decade. Just like, I'll draw the comparison to after the tech blow off in 2000. We saw a decade-long period where those stocks didn't do anything because they kept, every time they lifted their head, somebody else was selling because there was so much ownership of them. That's what the growth stocks will face. Maybe not biotech. I think that's a kind of its own situation, but certainly a lot of the tech stocks have been so popular for decades.
Yeah, I mean, it'll be interesting. Some areas that I guess I'm intrigued by: AI, battery storage, robotics, DNA sequencing, blockchain. There'll be winners, there'll be losers, there always is. But among that realm that I spoke about, some of them are going to pop their way into the lexicon of what we now call FANG +2, or let's call it basically the top 10. Look at 20 years ago, the Fortune 500 companies in the top 10. Only one of them, Microsoft, is now still standing in the top 10. That doesn't make the other companies irrelevant. It just means they're not what they used to be, and others have surpassed them. Completely off topic, a little bit back to gold and monetary policy. He who holds the gold makes the rules used to be a saying. I could argue it's now he who controls the money supply makes the rules. Henceforth, the true world leaders are the central banks, aren't they?
They sure have power, and I think they're going to have more power because they're going to be so necessary in holding things together, or turning things around. So they're going to have an awful lot of power. They're also going to be open to a lot of criticism because it's going to be a tough period. But yeah, I mean, that's, like I said, I'm not endorsing it. I'm not saying it's a good thing. I'm saying it's inevitable that we're going to see more money printed in the next couple of years than we've seen by a factor of many in the last 100 years. So it's going to be massive, and I guess with the printing press comes power.
I mean, I guess this question may be a little dated from a couple of months ago, but why are gold miners such as GOLD paying dividends instead of reinvesting into gold? And is that a sign of perhaps things should be bearish?
Yeah, I don't know. I will say this. I think, ironically, the gold and silver miners have done very poorly of late, and they're just starting to lift their
Right.
heads now.
Yeah.
Ironically, their managements have probably finally figured it out a little bit in the last couple of years. They're managing the cash flow now much more than they used to, and they're not getting caught up in, you know, going on buying sprees every time, gold lifts its head a little bit. I think you're seeing more discipline among the managements than we've seen in decades. So ironically, even though they're not in favor, they may be finally at a point where they can be looked at as, maybe some decent managements out there. So yeah, I'm not sure about the dividend question. They probably could answer that and give you a sound reason, but I think it's probably good that they're not just taking that cash and blowing it on another mine somewhere.
Yeah, that you could definitely make that argument. And perhaps my last question or two, oil. We didn't really talk about that. I had multiple very prominent guests on the last couple of months or heading into the end of the year in 2021, $100 a barrel. I might have even said $150 a barrel. And none of that really happened. What's your prediction shorter term? Could I call that through year end relative to oil?
Yeah, through year end, my view is that we're looking at a cycle peak here. I could be wrong, and I've certainly been beat up on Twitter because I kind of said that at $85. And,
I hear
but
you.
I did, the first time I said it, it went back down, it went into the low 60s. I think if I have my numbers right. And then it came all the way back, and it came back to 85. And I said, yeah, it's a double top, I don't think we're going to see it more. Well, obviously we're up in the 95 area now. So I missed it by $10, but I will say, I also, at $10 was a very lonely voice out there saying oil's going to originally 50, and then I raised it to 60, then 75. And I didn't get much above that. But so I rode the oil when people were pretty bearish of it in the first part of this rally. I'm just not, I'm not convinced that there's a lot left in it. I think right now everybody's bullish. It's easy to extrapolate and say it's going higher. It's 100, it's 110, it's 120. I tend to think we're probably going to roll over here, and people go, how can that happen? Supply demand's tight. I go, yeah, but the supply is artificially tight. That's been held back, and both by Biden's policies and also by OPEC. And if I'm right that the economy is decelerating here, I think you're going to see things ease up here on oil demand, and all of a sudden, once once the chart breaks, all those bulls turn into bears, or certainly turn into sellers, and you can break
Yes.
price pretty quickly. So my view is, at least for me, the majority of the move is over, if not all of it.
It's again a crystal ball, and you might have hinted at it earlier, but in that bleak future, looking a little further out, and who knows, but could you see oil being hard to fathom now, but effectively hundreds of dollars a barrel?
Yeah, I said it earlier in this show that I think in the bust you could see oil back in the 20s. I don't say 20, but in the 20s, below 30, you could see oil back there in the bust, because global demand is going to fall through the floor. It's going to be the biggest downturn in post-World War II era. And then coming out the other side, it won't happen all at once. It's going to happen gradually at first, and then really pick up speed later in the decade. But I said earlier in the interview that I foresee $400 oil.
Yeah, that's what I thought I heard you say.
and I think you're going to have a lot of people talking peak oil again. One of the big mistakes we've made, and it's idiocy in my opinion, but we got so caught up in the Biden administration, got so caught up in trying to speed up climate, change junk. They shut down they shut down supply, they shut down our ability to produce. There is zero chance that in the kind of, ramp up on the other side of the bust, that we're going to have anything close to alternative energy supplies that can meet demand. The demand's going to have to be fossil fuels. So the demand's going to have to be carbon based. And it's just naive of them to think they can kind of force the issue and shut down. What Trump did in terms of opening up supply was smart. And that's really the policy that could fix a lot of things right now, at least temporarily, is if they opened up supply. You take power away from OPEC, you take power away from Russia, you're independent in terms of your production. We know that's not their motivation. That's not what they're trying to do, make it easy on the citizens of the country. But it's just really wrong-headed policy that's gotten us where we're at.
Probably going to get me in trouble for asking. I promise my last question. It relates to things that we've been talking about without planning going into the interview about, and that is a little bit of potentially that bleakness looking whatever 7, 10 or more years out into the 2030s. And let's stay specifically here in the US. And I said, again, could we be a whole bunch of what's occurring now in San Francisco's, which unfortunately may appear likely. And imagine oil being that price. Imagine electrical grids being challenged, water, food, supply chains, big cities potentially in trouble. And I hope I'm completely wrong, by the way. But I think that you need to potentially mitigate some of these risks that are out there. And there's no one answer. There's not an easy solution to it, because you're not going to like a lot of the solutions, which I'll get to in some future ones. But if you had to give us a little bit of a ray of hope, what policy should the US put in place? Of course, it's not going to happen because politicians are garbage. Most of them suck. But if you were the president, David, what could we do we may have to bite the bullet for a couple of years in that time, but we would get out of it as a country. What could we learn? What could we do?
Yeah, certainly. I think energy policy is a big one in terms of,
right.
Providing the supply of energy will do a lot to mitigate inflation. At least in the short run, in the course of the next 5 or 6 years, so much of it is the things we're doing that are counterproductive, reversing those. So our policies on crime and on basically telling criminals they can do what they want, because we're not going to, particularly petty crime, we're not going to go after you. So go ahead and loot the stores. Go ahead and break in.
Yeah, we're seeing it now in San Francisco.
Yeah, no, I mean, it's lunacy. And, same thing in all the big cities is, we're basically letting the crazies run the insane asylum. It makes no sense. And unfortunately, I think a lot of it's deliberate, but, those are the things that I would turn back. Certainly the border policies are insane, all of those things. And the sad part is we need immigrants. But it should it should be an organized policy. There's a lot of things we could liberalize in terms of bringing in immigrants that can fit our needs, that will assimilate into the country. And, this idea that we're just letting people kind of walk across our border and there's no sovereignty, that's nuts. So, I mean, all those things I think are going to contribute to the chaos, because you got people coming from other cultures. They're not assimilating. They're just coming in and bringing their culture with them. And it's not what we're used to in this country.
Yeah, like you could see some states that I can make the argument are doing it right relatively. Texas, Florida, maybe Tennessee, Nevada. And look at those states. They're more fiscally responsible. And unfortunately, if this really gets bad, especially Texas, I mean, I could see them saying, we're out and come and do something about it. Now, again, these are all things that are probably going to get the video in trouble. So enough about that. Really insightful with your macro strategies. Again, almost 50 years. So I undercut you a little bit for your Wall Street experiences. David, again, I highly recommend to everyone to follow your Twitter. How could they do that?
Sure. Yeah, I'm on Twitter most days. The handle is @DaveH_Contrarian. So @Dave, not David, but @Dave H. Contrarian. And I also put out an investment letter quarterly. It's by subscription, but if anybody has an interest in it, just direct message me on Twitter and I can provide you details regarding cost and all of that.
Yes, a couple of quick closing comments on my end. I highly recommend following David on Twitter. He has a very big following and it's rightfully earned. And definitely, I think it would be foolish not to DM and reach out to him and learn more about what he's doing in his subscription services. Because again, this is going to come down to information, making the right tactical decisions, and it's going to, I think, be worth the newsletter probably times about 1,000. So it just simply is going to make a lot of sense. In other words, David's undercharging it. You're lucky. You should be able to get it now. So I highly recommend that follow and a chance to reach out. Everyone, again, we did talk about investments, although broadly, I will remind people that this is our opinions at this point in time. Things may change an hour, a day, a week, or a year later. I don't know when you're going to listen to this. Also, a lot of it's opinion. A lot of people, you have your own risk tolerance, time horizon, cash flow needs. When you invest and you're active in the markets, there is something that could happen. It's called you could lose money. So again, you need to do your own diligence. And really my big thing that I always mention is think for yourself. You may respect others' opinions. You may use that to help formulate your thesis and thoughts, but at the end of the day, you need to make your own decisions and think for yourself. Everyone, I'm Angelo Robles, host of the Angelo Robles podcast. We're a family office on YouTube. Go and subscribe. I'm also the founder at Family Office Association, and that would be the same website, familyofficeassociation.com. Learn more about membership and some of the things that I spoke about today, about how significant and successful families can become more significant and successful, how to do that over the next couple of years, and the challenges, which I agree with David, that are just inevitable, that are really around the corner. And a lot of that self-sovereignty and sovereign risk and global diversity. And those are things I know. I help families with this practically every day. So feel free to reach out. Maybe I could impart a little bit of insight and maybe learn a little bit from you all as well. Again, David, thank you so much. I look forward to the next time. Thank you.
Yeah, thanks, Angelo. Enjoyed it.
My pleasure. Bye-bye.